In today's episode of the Brisbane Property Podcast, we are going to be uncovering the 8 mistakes, the most common mistakes that property investors make here in Brisbane. And we're also going to be discussing how you can avoid them. If you're a property investor considering Brisbane, this episode should not be missed.
Welcome to the Brisbane Property Podcast with your hosts, Melinda and Scott Jennison.
Hello, everyone, and welcome back to another episode of the Brisbane Property Podcast with Scott and Melinda Jennison.
Welcome. Yeah, that was a very quick introduction. Yeah. Great to have you back again on another episode of the Brisbane Property Podcast. And today we're going to be exploring some of the biggest mistakes or the most common mistakes property investors make, not just here in Brisbane, but across Australia. But we are going to specifically talk about Brisbane mistakes as well. And hopefully, if you are a property investor, this episode will provide some insight for you into how you can make a better choice when selecting an A-grade asset.
I think that's something that when you talk to people and you have the barbecues, I guess, on the back deck, which is a very common place where everyone knows about real estate. Every family member, every friend, everyone's experts in a way. But I think that's an area that you probably hear less of people talking about mistakes. So people generally talk about, what was great or how they did this well. Most people, I guess, will probably hide under a rock and not want to come out and be open about mistakes they make. I think it's something that people need to be really aware of, because making the mistake is such a critical thing in your journey in investing in that wealth side of things, that if you do it right, it's great and it can set you up really well for the future. If you do it wrong, it can actually set you back so much time as well.
It is always a little bit of an awkward conversation. And I know, Scott, for you and I, whether it's family events or social events with friends, when the topic of property comes up, we tend to sit back. We tend not to be involved in that conversation because everybody has a very strong opinion. And of course, being experts in this field, we tend not to share our professional opinion at social functions, although it's so interesting to hear what other people often talk about. And it's often quite alarming in terms of some of the things that people say, because where they're obtaining their information from is potentially not a factual source. It might be through the media, it might be through hearsay, or it might be through other family and friends. So today we're really going to take a deep dive into some of the mistakes you can avoid if you are looking to invest in property, especially here in Brisbane.
It'd be interesting to ask the listeners what they think about that. If you're sitting around and you're having a conversation, and if you look at, say, for example, as Melinda just mentioned, if we were sitting around and someone said, I'm looking at buying, this or that, and we probably strongly disagree. Should we voice that, or should we just sit quietly and have our own thoughts on it and then hop in the car later and go, I wouldn't do that. Sometimes I do think it's worth actually standing up and just saying, hey, look, you really need to think about it or talk about it. And obviously different circumstances for different people. You have to take that into account. But, obviously making those mistakes, you do want people to avoid them. So maybe we should stand up a little bit more and say, hey, do you want to have a chat about that? And that could make that barbecue go a lot longer. So
absolutely. Look, I think I'm going to start with probably one of the biggest mistakes that we see property investors make. And this often comes about when we first engage with a property investor, when they reach out to our business here at Streamline Property Buyers. If they're a property investor, by the time we're chatting to them, we generally will know that they're looking for an investment purchase. And when we jump on the phone with some people, one of the first questions that we ask is, well, what are you trying to achieve by investing in property? What are your property investment goals? And that, for a lot of people, is a question that they may not have considered in detail. They might say, I just want to secure my future. I want to provide for my family. I want to generate more income. However, getting more specific about what is it you're really trying to achieve by investing your hard-earned cash into property, it's going to help you to get clarity. And one of the first things that we do with new clients that engage our services is to ask those clients to fill out a fact finder. That fact finder helps us as qualified property investment advisors to really understand their current circumstances, as well as their expenses and their their income so that we can get an understanding of what their surplus cash flow is. We also look at assets and liabilities so we can understand what their equity position is. But more importantly, what are their goals? And for some people, even at that point, they can't articulate what they are trying to achieve. And the goals that you set for yourself for property investment generally should align with your risk appetite, and also should align with, your family lifestyle and your stage of life. So it is something that people quite often need help to articulate. And of course, that's what a professional team can do. But if you don't know where you're going and you simply start with budget, you can obviously select the wrong asset based on your requirements. So you really need to understand where you are trying to head, what is the end goal, and then working with the numbers, you work backwards from there to devise the strategy and then implement that strategy over a period of time.
Now, as we get going, I'm not sure whether we did mention, just so our listeners know, we'll go through 8 mistakes. So these are 8 major mistakes. And obviously, as Melinda started on, number 1, not setting goals. So one of the biggest things, as you said, not setting goals. And we'll question those things as well. We might have people that might contact us and say, I've had this a few times. I want to own 10 properties. And that's, if they're trying to build up a portfolio, again, you could question that. And this comes back, and I'll probably say this so many times, is that it's individual specific. So some people that might be what they actually is good for them, or that might be what they like, and the risk appetite, as you talked about. I mean, the first thing you could say to someone if they say, I want to own 10 properties, that's 10 lots of property maintenance as well. So you've got 10 tenants, for example. So if that's something you're prepared to have, and you can do the paperwork for it, or you've got someone to do the books and all those types of things, they're the simple things you need to understand. Is it quantity or is it quality that you want to invest into? And obviously so many other goals to setting, if you're trying to set up for future, for retirement, for children's futures, all those types of things. There's so many things to consider when setting goals.
And if we just talk a little bit more about that, it is a common strategy. I want 10 properties in the next 10 years, or over my lifetime, I want to accumulate 10 properties. There's a very big difference between 10 blue chip properties and 10, entry-level properties. So the quantity or the number of properties that you add into a portfolio becomes less relevant, in my opinion. It's more about the value of those properties and the potential growth or the yield across that portfolio. And we never generally measure success by the number of properties within a portfolio, but more so it's the equity position of that portfolio, how much wealth you have generated as a result of selecting the right assets, or alternatively, for some people who may be approaching retirement age, what is the cash flow position on that portfolio? And therefore, how much money is being put into your bank as income as a result of that investment strategy over a lifetime. So there's definitely different ways to assess whether you have achieved certain goals that you may have set out. But, it is interesting that a lot of investors start with the number of properties as opposed to true investment targets based on numbers, which are quantifiable equity positions or cash flow positions in the future.
I'll throw another quick one with you while we're talking about setting goals. Say for example, I earn good money and I'm on a good wage, and so is my wife. And just as an example, if I came to you and said, look, we earn X amount and we're in a certain tax bracket, I want high cash flow.
And quite often, this is what we find in a strategy session with clients. And as a qualified property investment advisor, we really would need to unpack how they're purchasing that property that they say they're wanting, a high cash flow property in their portfolio. If they're purchasing in their own names and they're on the highest taxable bracket in terms of their income, then there's going to be tax implications for generating cash flow now, depending on their age and the investment time frame. That can also have implications for, their future wealth position, because, we have shown in previous episodes that episode 159, for those that want to go back and listen to this, we talked about, does high growth and high yield exist in Brisbane? And you will find out through listening to that episode that when we look at short-term periods, that might be the case, but certainly historically over long-term periods, it's simply not the case. So people need to understand what their primary objective is. And sometimes it does take professional input to get that clarity and to ensure that the goals that you do have also align with your personal circumstances. So it's really, about getting that clarity up front.
So we set some goals. And then obviously once we've got some goals set out in our strategy side of things, basically we need to move into that strategy, and we need to set a clear strategy on what we're looking for to achieve those goals.
Absolutely. And I think, again, the strategy for every individual may be slightly different. We are seeing more and more, especially over recent months, we are in a higher interest rate environment. Some of the investor clients that we are working with will have a yield requirement. And what I mean by that is that when they achieve or have a pre-approval in place from a bank, that pre-approval requires that client to earn a minimum amount of income through rent on the property that they're purchasing to satisfy finance for that purchase. So what that means is that you really have to consider the income that a property will generate as well as the location that you're purchasing in order for the bank to extend that funding. Now, of course, that can influence the type of strategy that an investor might be considering, because there's a lot of very high growth assets, for example, which may have a median value in excess of $1.5 million that will have a lower holding yield. That is the percentage of income as a portion of the purchase price. However, there may be some different types of properties. For example, a unit will have a higher gross cash flow position because units yield higher. They will generate a higher amount of income as a portion of the purchase price. And there's lots to be assessed and unpacked even in assessing house versus unit in terms of yields, because costs for holding a unit or townhouse under a body corporate scheme will be different compared to holding a house. But this is where getting advice and really understanding the numbers up front is going to put you in the best position to achieve the goals that you've set out to achieve long term.
Now, when you talk about the yield side of things, this is going to be based obviously on your borrowing capacity, how much you're borrowing to how much you're putting in yourself. We do see a little bit of that sometimes in self-managed super fund investing as well, where that can be impacted on that yield side of it. So that's something you really need to make sure you're aware of on what the yield will be in the holding cost side of it as well. When you touched earlier a little bit on risk appetite, understanding individuals' risk appetite, that will come into play a lot in this strategy side of it as well on what you're trying to purchase.
Absolutely. So for some investors who have quite a high risk appetite, they may consider higher risk strategies, including a buy and renovate or a buy and redevelop type of strategy. Of course, these are quite sophisticated ways that you can manufacture equity within an asset or within a portfolio. Someone with a much lower risk appetite may prefer a set and forget property, something that they can purchase, a tenant can move in and they can pretty much, hold that asset long term without any major works being undertaken. So again, that's going to vary depending on the individual. As I've pointed out, depending on someone's taxable income structure, or perhaps the way they're structuring the purchase, the entity that they're using to purchase the property, they may have certain growth targets or certain income targets that they're trying to achieve. If they're looking at commercial property, they may be looking more for income. If they're looking at a certain segment of residential property investing, they may be looking specifically for high growth and holding that asset over the next 30 years and looking for some negative gearing benefits that will come as a consequence of that strategy. So the strategy is variable depending on the individual, the goals that they have set, and their risk appetite. And these all need to be considered because if you fail to devise a suitable strategy, it is likely that you won't achieve the goals you've set out to achieve.
Now, one thing you did mention there, which I'm sure does have a big impact on it, is obviously people's age. And obviously moving to different parts of their age and their lifestyle and what they're after. That'll obviously have an impact then on the type of property they're looking to buy, because obviously you'll change as you get older and you move into that later in life retirement sort of stage as well.
100% age does come into play. That can influence the investment time frame. But again, it comes down to personal circumstances, and time frames are something that we would assess based on the individual. But also, there's a lot of different reasons why people are looking to invest in property. So sometimes even outside of age, there might be a very specific purpose behind the purchase, and it might not be for that individual. It might be for their family, and they're looking to build wealth for the next generation. So all of these things need to be discussed up front before you actually go out and start looking at properties.
Third one that I think is really important, and this can be sort of rounded, I guess, into a lot of areas, but I always talk really strongly on the team and the people that are around you. So whether it starts from your accountant or your advisor or your mortgage broker, right through to whether you're using a buyer's agent, or whether, everyone in that team, I think is very, very important. So you've got the right people around you with the right qualifications.
Yeah, look, a story recently, we had someone that we were speaking to reach out to us in a very strong equity position, owned their home outright, recently sold a business, so quite cashed up and ready to build out an investment portfolio, a very aggressive investor. Now, we referred that client to an accountant to seek some professional opinion around building out that portfolio through multiple entities to ensure that we were going to create a tax-effective strategy. And in between that referral and us, continuing to work with this particular person, they went to a seminar. They went to a property investment seminar, and unfortunately, they've, potentially landed with people that may not build out that portfolio in a way that's going to be personalized. And we've talked about, the risks associated with going to an investment seminar where they're selling brand new stock, and they're I guess packaging this as property investment advice. The question to ask is, are you working with a qualified property investment advisor? These people are certified with Property Investment Professionals of Australia. So unfortunately, in Australia, the property investment industry is unregulated. So there can be anybody providing you with investment advice, but they're not qualified to do so. The only people that are qualified to do so are QPIAs, or Qualified Property Investment Advisors, who are certified through PIPA, or the Property Investment Professionals of Australia. And of course, here at Streamline, we're very proud to have 3 fully qualified property investment advisors, and another team member is currently studying to become a qualified property investment advisor, and they all work under myself as their mentor to upskill and ensure that we are providing that tailored advice. So that's one thing that I'd be asking: are you dealing with a QPIA? The other thing that I will mention is that there's a lot of borderless investing happening. So you might go and meet someone in Sydney and they're suggesting to invest in regional Queensland or Southeast Queensland, but they're not here with boots on the ground. A lot of people will make recommendations for where to invest based purely on data. Now, if you haven't already tuned into episode 142 of our podcast, why relying solely on property data can be misleading, I encourage you to go back and listen to that episode. It will be, hopefully, it will create some alarm bells for you, things to be aware of, so that you can understand why data alone may be a risky strategy to rely upon. Remember, buying property involves an art and a science. The data is the science. The art is understanding what locals in that area want, and that comes down to perception and having boots on the ground. So that's just a big tip. And I encourage you to go back to episode 142 to get that information.
It's interesting and I'll throw something to the listeners just to probably have a think about. When you talk about using a QPIA through the Property Investment Professionals of Australia, it's a massive amount of money that people are investing. We're probably talking $1 million plus when people start to invest in property. And some people will go and do this with just anyone that doesn't really have any qualifications. Or
but a good marketing message, perhaps?
Good marketing message, barbecue, like I talked about, and the family and the friends saying, yeah, that sounds great. Go for it. Go and do it. A simple way I look at this, and I probably from my background where I've had a building background all my life and come from the construction side of it, would you get an a qualified electrician to come in and do your electrical work, or would you just do it yourself? Would you get a builder to come in and build your brand new deck or your extension or whatever else, or do you just go and do it yourself, or you use someone that's a friend or a mate, or someone that just says, oh, I could do that for you a lot cheaper?
Do you get a mechanic to service your car, or do you do it yourself? And
exactly.
there will always be some people that
Some
will do
people
things
might.
themselves.
Exactly. But it's just something to consider, when it's such a small amount, you'll probably, if you go and buy a brand new car, you'll probably get someone to go and actually look at it, a mechanic to have a look at the car and check it over. And you're probably talking about $50,000 to $100,000, as opposed to if you're spending millions and you're not getting someone that is qualified to help you with it. So it's just something to, obviously, as we touched on the very, very start, avoid making mistakes. And I think this is one area you can avoid making mistakes as well.
So that's the first three. We're going to go on to the next mistake we see a lot of property investors make, and this is investing purely for tax or depreciation benefits. Now, unfortunately, there's going to be some accountants that will refer you to developers or to salespeople that will sell you off the plan products or brand new products because of the depreciation benefits. Now, buying property for depreciation benefits is not an investment strategy. Buying property to generate income or to generate capital growth is the strategy. The depreciation benefits is a side effect of a certain strategy. So depreciation in itself is writing off the value of the asset. The value of the property that you're buying, the building itself is being written off over time. So remember, land appreciates, buildings depreciate. So you get the benefit of the tax deduction through annual tax refunds. However, when you go to sell, it actually reduces the cost base of the asset. So depreciation in itself or taxation benefits, that's not an investment strategy. And if there's anybody that's advising you to invest for depreciation benefits, then I'd be very careful with taking that as advice, because it really should be about what you're trying to achieve in terms of growth or income targets in the future.
Yeah, I think you make a lot more money with capital growth than what you will on your depreciation benefits as well. What about it when you talk about investing in your own backyard? I mean, I know we talk about, some people say, oh, I want to diversify and I want to buy properties in Sydney or Perth or Brisbane and jump around everywhere, as opposed to, some people might say, look, I just want to buy properties in my own backyard.
Yeah. And a lot of people feel that this is a low risk strategy. When you know your neighborhood, you have a level of confidence that you may not have elsewhere. There's things that need to be considered, though. Of course, if you are living in that particular location, you might own a principal place of residence. Then you lack some diversification if you're buying just around the corner. Obviously, you can drive by, you can see how the property might be looking all of the time, but obviously that does bring an element of risk into the portfolio. I will also say that there's things to consider in building out a portfolio that might be very close to where you live. For example, land tax. If you have more than one or two assets as investment properties, then and they're all sort of scattered around your backyard or in local areas, you potentially, depending on the structures that you're purchasing it in, may reach land tax limits because you're purchasing all within the one state. And I'll also say that particular area that you live may not actually be the best area to target from an investment perspective based on what you're trying to achieve. So it will come down to your risk appetite as to how you feel about looking at different locations. But I feel with the advancement of technology and also with an improvement in the number of qualified property investment advisors that are located nationwide, there are other options that may be available to you. And it's just a case of exploring those options and getting a feel for what you're most comfortable with.
And sometimes buying in your own area might actually be a good thing. Again, we're talking about looking at individuals and not having that one size fits all when it comes to investing. It's that individual, as we started on, the setting goals, the strategy, the risk appetite, all those types of things. When you talk about buying in your own area, sometimes the emotion can get in. Now that's another mistake. So when your emotions get involved, when you're investing into property, that's when you can actually make big mistakes as well.
But of course, if you're a builder, as you are, Scott, investing in our local area has made sense for us because we are very comfortable with renovating or redeveloping property. So, we've allowed for land tax issues simply because we can, purchase in different entities as well. So again, it's about understanding the individual, their circumstances, their skill set, and what they're actually trying to achieve through their portfolio. So it is something to be aware of, but it's not a deal breaker for everybody.
That emotion is huge as well. Like as I mentioned, when you go to a property or you look at a property and go, oh, I don't like the color of the tiles.
Don't like the kitchen layout.
I don't like that. Certain things are okay. When you talk about kitchen layout, sometimes that can be important. It needs to be something that's going to be desirable for people to live in. So little things you can to look at, or you can change them. Again, this is the risk appetite or the ability to be able to do these things. But then there's certain things that they're not going to change the value on the capital growth side of it just because the tiles are a different sort of color or a different size and you don't like them. It's still the same bathroom. It still works. It's still functioning. It's still the same location. And you might be close to public transport and there might be great growth in the area. So little things like that emotional side of it, sometimes we might have to tell our clients that you're actually not going to live there, don't forget.
I'd also say, especially for a lot of investors that are not local to Brisbane, there's a fear around tin and timber homes. And as we all know, the character Queenslander home is very typical of Brisbane, and it's one of the most desirable types of properties, especially in blue chip locations. So when we speak to investors who may be from Melbourne or Sydney or other parts of Australia, and they say, I definitely want a double brick home, we always say that's going to be almost impossible to find in Brisbane because most of our homes that are brick will be brick veneer, not double brick. And, the older homes in Brisbane typically are tin and timber, not double brick. So the style of home that you might be familiar with and in the area that you live may not actually be the style of home that's desirable for the demographic who lives in the target location. And that is the critical piece of information. You should be targeting the property that appeals to the demographic of who lives in that target location, not the type of property that you like for yourself. So that's a big tip in that regard.
Another one is not knowing how to find investment-worthy location. So location, you've heard everyone watch the TV show, I think, location. It's number one, location when you're picking a property, knowing the area. And obviously there is a lot of data behind this side of it, which is obviously your side, especially.
Sometimes I think that people get analysis paralysis. There is so much information available today, but unfortunately, a lot of the information that is available is quite misleading, and it's no wonder that people get confused about, where they should be purchasing an investment property. For people that are looking to understand Brisbane and how it might differ from other locations, a great episode that I can refer you back to is episode number 194. And in that episode, Scott and I actually discussed Brisbane's thriving suburbs over the last 3 decades. And we looked at the gentrification process in Brisbane and how that has taken place and what that means for our city both now and into the future. So if you're really trying to understand Brisbane, how it might be different to other locations around Australia, I'd highly encourage you to go back to episode 194. Obviously, if you're working with professional qualified property investment advisors, you're going to get a much better understanding of how you select location and why you select certain locations, because location selection should be objective, not subjective. And what I mean by that, there should be specific selection criteria that are used to identify a location that's going to lead you to the suburb itself. However, then you must overlay that subjective information. You'll overlay. If I can just go back, there's objective assessment criteria that you use when you get to a suburb level. You'll use some subjective information to understand which parts of a suburb are going to be better than other parts of the suburb. And that comes down to local knowledge because, for example, we might identify a target location and then we will say to our clients, but we won't buy to the west of this road. We'll only buy to the east. And these are the reasons why. So we don't buy the whole suburb. And that's where your local knowledge or the art of property investing comes into play.
And there's all those trends that you talk about as well, the growth in areas. I mean, one thing we do look at is, we talk about a lot is that capital growth side of it and the scarcity. And that's something that's really, really important when you're looking to buy investment properties, is the scarcity side of it as well.
Absolutely. The last one, number 8, one of the biggest risks I think property investors make, and that is actually not doing enough research or due diligence, or taking unnecessary risk with offers. Now, this is a big deal, especially here in Brisbane. If you don't know the area, if you're unfamiliar with the area, you really haven't done your research or the due diligence, you could be making a really big mistake. Obviously, there's flood risk, there's valuation risk, there's local knowledge risk in terms of, is this area appealing for owner occupiers in this particular location? People are taking risks with offers because of a low stock environment where they're failing to do the due diligence, omitting building and pest inspections, exposing themselves to unnecessary risks. So these are the things that can actually cost you a lot of money if things are identified too late. I will say, a lot of people rely on online calculators for assessing value of a property as well. And if I can draw your attention back to episode 203 of the Brisbane Property Podcast, we talked about the reliability and accuracy of automatic valuation reports. And those are those online tools that I've just referenced. That's going to be a great episode for you to understand if you can rely on those valuation estimates or not. So I'll encourage you to go back and listen to episode 203.
There's a lot of due diligence to do. And that's, for our clients here at Streamline Property Buyers, we can because we have a team, we can turn that around fairly quick. So, when you talk about overlays and there's different types of flooding here in Brisbane, it's not just, we are a river city. But there's river, there's creek, there's overland flow. There's so many different types to consider and make sure that you avoid. There are so many things to look at, and even what's underground, sewer lines and things like that, and services. There's a lot of things to consider, not just price and how much someone thinks it's worth, but there's also those things, again, like the whole episode's about, avoiding making those mistakes, because once you've purchased it, it's too late.
Land zoning, future developments, what's coming to the area, what's the future supply risk. These are all things that absolutely must be assessed. So if you're not getting that information, if you're not understanding that information before you're making an investment decision, then, there could be a red flag, and I'd be suggesting that you do ask more questions. If you are interested in really getting a snapshot view of the current landscape in terms of the risks and opportunities that exist in the Brisbane property market from an investment perspective, episode 200 is a fantastic episode where Scott and I interviewed Antonia Mercarella, who is the CEO of the REIQ, as well as Nicola McDougall, who is the chair of PIPA, the Property Investment Professionals of Australia. That's a fantastic episode that provides a great summary of the current state of affairs in Brisbane, and that's going to help you get further clarity on, risks and opportunities associated with choosing a great investment property in our city.
So I've jotted down a few things, but I'm going to keep it really, really simple and ask for 3 takeaways. My 3, and I just think it's pretty simple. You need to plan and set goals. Number 2 is avoid emotions. And number 3 is to have the right people and the qualified people to work with.
Absolutely. I agree with those top 3 takeaways. So hopefully you too can avoid some of the mistakes that other property investors make. We do see a lot of investors that come and work with us. They've already made the mistakes and they see the value in aligning with professionals when they're going to continue to build their portfolio. Remember, a mistake up front can set you back years, but making the right investment choice up front can actually fast track a portfolio build. So, and the investment to get professional input up front is going to save you a lot of time and a lot of money long term.
Another really quick last tip to avoiding making mistakes before we wrap things up. If you're not living in Brisbane, you're making a mistake because you're avoiding our beautiful winters. So I'll just throw that in right at the end. Look, hopefully that's been helpful and given you some tips. And as we say, we hate it when people do make mistakes. It really does hurt. It hurts us. And that's why we're here. And that's why we like to help people to avoid that and get them ahead in life. So as usual, it's been great talking. I will let Melinda wrap things up. And from me, thanks very much for listening. Take care and bye for now.
Look, I think it's the whole purpose of why we share weekly episodes on the Brisbane Property Podcast. We're trying to educate people at no cost to help you avoid making mistakes. I hope that this episode has really drilled down into some of the biggest mistakes we see people making. But as always, if you have enjoyed this content, please share with family and friends. We really do appreciate when you share this knowledge with others. And also we love hearing from you. So we love it when you leave us a review on your favorite podcast player. Don't forget to subscribe, and we look forward to bringing you some more amazing content next week. Until then, bye for now.